Profit and not-for-profit organizations. Nature and objectives of profit organizations. Profit-seeking organizations operate primarily to generate financial returns for their owners, typically shareholders. Their central strategic financial objective is the maximization of shareholder wealth, which is achieved through sustained profitability, efficient capital allocation, and long-term growth. Managers must balance shareholder expectations with other stakeholder interests such as employees, customers, suppliers, and governments. Financial objectives usually include profit growth, dividend stability, cash generation, and efficient use of capital. While financial returns dominate decision-making, companies increasingly integrate non-financial objectives such as environmental responsibility and social impact to support long-term value creation and stakeholder trust. Nature and objectives of not-for-profit organizations. Not-for-profit organizations operate primarily to provide services or benefits rather than to generate profits for distribution. Examples include charities, government bodies, educational institutions, and professional associations. Their objectives are normally mission-driven and focused on public benefit, social welfare, or community development. Financial resources are used to maximize service delivery rather than shareholder returns. Consequently, financial objectives often focus on ensuring sustainability of funding, efficient resource allocation, and accountability to donors, taxpayers, or stakeholders. Because outcomes such as improved health, education, or social welfare are difficult to quantify, performance evaluation often relies on qualitative indicators and service delivery measures rather than profit metrics. Performance measurement differences between the two types. The performance of profit organizations is typically evaluated using financial metrics such as profitability, return on capital employed, and shareholder returns. In contrast, not-for-profit organizations assess performance through value for money, VFM, focusing on economy, efficiency, and effectiveness. Economy refers to minimizing resource costs, efficiency evaluates the relationship between outputs and inputs, and effectiveness measures the achievement of intended outcomes. This framework recognizes that public or charitable organizations must justify the use of funds while delivering meaningful social outcomes. Because benefits such as improved health or education may be intangible, measurement requires both quantitative and qualitative assessment approaches. Quoted and unquoted companies. Characteristics of quoted companies. Quoted companies are corporations whose shares are listed and traded on a stock exchange. Listing enables shareholders to easily buy and sell shares, increasing liquidity and access to capital markets. However, listed companies face extensive regulatory requirements, disclosure obligations, and scrutiny from investors, analysts, and regulators. Strategic financial decisions must therefore consider market expectations, share price performance, and investor confidence. Management must maintain transparent financial reporting and consistent strategic communication to satisfy market participants. The wider shareholder base also increases pressure on management to deliver sustained financial performance and adhere to strong governance standards. Characteristics of unquoted companies. Unquoted companies, also known as private companies, are not listed on public stock exchanges, and their shares are typically held by a limited number of investors such as founders, families, or private equity investors. Because their shares are not publicly traded, these organizations often face lower regulatory requirements and less external scrutiny compared to quoted companies. However, they may find it more difficult to raise large amounts of capital because they cannot access public equity markets. Strategic financial decisions may therefore rely more heavily on private investment, retained earnings, or bank financing. Ownership concentration can also lead to greater control by key stakeholders. Strategic implications of being quoted or unquoted. The distinction between quoted and unquoted companies influences financial strategy, governance, and stakeholder relationships. Quoted companies must prioritize transparency, investor relations, and compliance with regulatory frameworks. Their share prices provide a continuous market valuation of corporate performance, influencing management incentives and strategic decisions. Unquoted companies often enjoy greater strategic flexibility and confidentiality, but may face funding limitations and reduced liquidity for shareholders. Ownership concentration may also lead to faster decision-making but increases the risk of conflicts between controlling owners and minority stakeholders. Ultimately, the choice of corporate structure significantly shapes financial objectives and strategic priorities. Private and public sector organizations. Private sector organizations and their objectives. Private sector organizations are owned by private individuals, investors, or corporations and operate primarily to generate financial returns. Their main objective is typically the maximization of shareholder wealth through profitable operations and efficient resource utilization. These entities compete in markets and rely on revenues generated from customers to sustain operations. Strategic financial management focuses on profitability, growth, cost control, and capital efficiency. Decision-making is influenced by competitive pressures, market demand, and investor expectations. While financial performance remains central, private sector organizations increasingly recognize the importance of sustainability, social responsibility, and stakeholder engagement to maintain long-term competitive advantage. Public sector organizations and their objectives. Public sector organizations are owned and funded by governments and operate to provide essential services to society rather than generate profits. Examples include hospitals, schools, and infrastructure authorities. Their objectives are typically aligned with social welfare, public policy goals, and equitable service provision. Because financial profitability is not their primary aim, performance evaluation emphasizes service quality, accessibility, and efficiency in resource utilization. Public sector organizations must also maintain transparency and accountability in the use of taxpayer funds. Strategic decisions often reflect political priorities, social needs, and regulatory constraints rather than purely financial considerations. Strategic management differences between sectors. The strategic management of private and public sector organizations differs significantly in terms of objectives, accountability, and performance metrics. Private sector entities focus on financial returns, competitiveness, and shareholder value creation. Public sector organizations prioritize service delivery, social impact, and equitable access to resources. Financial management in the public sector often involves budgeting, cost-benefit analysis, and value-for-money assessments rather than profit measurement. Furthermore, public organizations face greater political oversight and regulatory constraints, which influence strategic decisions. Despite these differences, both sectors require effective financial management to ensure sustainability, accountability, and optimal use of resources.